We're here live at the Mulungushi International Conference Center for the panel discussion around how regulations can promote impact investment. So who better to discuss it with than two regulators, a lawyer, and an actual investor who's joining us online. Let me welcome the panelists who are here today. We have Sharon Sakuwaha, a partner at Moira Mukuka Legal Practitioners, who's joining me here. We've got Mutumboi Mundia, Director of Market Supervision at the Securities and Exchange Commission. We've got Naomi Fulaza, who's the Director of Restrictive Business Practices at the Competition and Consumer Protection Commission. And joining us online is Stephen Macharia, Investment Manager at FSB Africa Investments. Good morning, Sharon. How are you today?
Good morning, Mafipe. I'm very well, thank you. And yourself?
Very well. So let's talk about impact investment and the link into regulation. What's the current legal framework around impact investing in Zambia? And how does it need to evolve to attract more investment?
Thanks for that question, Afipe. The current state of the legal framework that governs impact investment is pretty much non-existent. Our current legal framework was not designed to facilitate the sustainability objectives of today. The world has evolved. There's a focus on sustainable value, whereas our framework was designed at a time when the focus was on financial return, profit maximization. Mm-hmm. Shareholders are looking for sustainable value. They're looking at other metrics apart from financial return and profit maximization. There's need for regulation to equally evolve, to take into account the needs of investors and the needs of shareholders. And I think the starting point when you look at regulation and the direction it needs to take is the fiduciary duty. The fiduciary duty is at the core of each and every investment decision that's taken, each and every business decision that's taken by a corporate director. Now, when you look at the current state of the fiduciary duty and the way it's interpreted, it has a very narrow focus on, obviously, financial return. It doesn't take into account ESG factors. There's need for deliberate regulatory intervention to bring this duty in tune with the 21st century needs of the investor.
Let me see if I understand this correctly. Because our regulations were set up pre the focus on ESG, there are no specific requirements around it, particularly around fiduciary duties of directors. So you believe that if we revise the regulations, it would be more attractive for impact investors?
Correct. I mean, if you look at company law, for instance, in 2017, for the first time, the New Companies Act codified directors' duties. And among those duties was the specific inclusion of fiduciary duties. Now, the legislation didn't go a step further in terms of defining what factors, for instance, a director needs to take into account in determining what constitutes the best interests of a shareholder, or the factors that need to be taken into account in determining or in promoting, in taking decisions that promote the success of a company. And I think we need to adopt a similar approach to that taken in the UK Companies Act of 2006, which goes a step further to outline factors that directors could take into account when they are taking decisions that promote the success of the company. If you look at those factors, they are largely ESG factors. So that's one for corporate directors. When you look at the regulations around, for instance, investment funds or even pension funds, the focus is on the financial return. So the prudential investment principles make no mention of ESG factors. And in the NAPSA investment regulations, for instance, where there's specific reference to fiduciary duties, the focus is on conflict of interest. So I think this is a big impediment. If, for instance, the regulation gave the fund managers an option to consider ESG factors, or even gave guidelines of some sort, it would give fund managers the impetus to take these factors into account. But currently, because the regulation focuses on financial return alone,
it's an opportunity missed.
Exactly.
Okay. So the legal framework is one side of it. Another part of it, the regulators who are further along. So let me switch over to Mutumboi and say that let's talk about the role of SEC, Securities Exchange Commission. So how are you supporting an enabling environment to draw in more impact capital into Zambia?
Thank you very much. And just maybe also let me take the opportunity to thank the organizers of this very important platform. So we heard the governor that clarified the initiatives that are taking place basically in the financial sector. And the governor was on point by emphasizing that we are working as financial sector regulators to put in place frameworks that support ESG reporting. I think suffice to mention or to elaborate on some of the efforts that we're making as financial sector regulators at a tripartite level. And what I mean by that is we have 3 financial sector regulators who you know, SEC, Bank of Zambia, Pensions and Insurance Authority. So at that level, we have actually put together a working group, a mainstreaming green working group. And the effort of that working group is to basically be able to introduce reporting frameworks where we motivate the practitioners or the intermediaries within the financial space to begin to factor in green financing, and as far as we're concerned, impact investments in the way they do their business. Our emphasis is to promote the UN SDGs as a very good starting point. And yes, we will be making reporting on ESG mandatory in the medium to long term in this jurisdiction. I think for us, we have partnered already with technical assistance such as the Biodiversity Finance Initiative to basically ensure that whatever frameworks we put in place are international and also are intended to achieve the key objective for our jurisdiction. But zeroing in on the capital markets, we are really at a very good point in time of putting in place interventions of how we want to do business and doing business responsibly and sustainably. I would like to quickly sneak in the fact that there has been discourse over the years in terms of how we attend to inadequacies of the capital markets. If you look at the report that was launched yesterday, it didn't shy away from stating that there is a need to enhance the quality of intermediary that we see in the capital space. Mm-hmm. And as a commission, working together with the Ministry of Finance, who are our line ministry, we have listened to the issues that have been raised in terms of how we develop sustainably. And as we speak, the Minister of Finance is seated with a document that is taken to Cabinet, which is the Capital Markets Master Plan. And in that document, several interventions, several policies that will be put in place to address issues concerning even what we are here for, greening our economy, and definitely ensuring that we are a preferred destination for impact funds at the Zambian capital market. So maybe, Mr. Moderator, just to say it for what it is, we are positioning as a Zambian capital market to make Zambia the preferred destination for whether it's brown funds, green funds, or indeed impact investments. We want Zambia to be the recipients as a preferred destination.
And regulators are key to that. But let me move on to our other regulators on the panel. And we have the CCPC. Tell me about your role in the green discussion regulatory space.
I'm from the Competition and Consumer Protection Commission, and the commission basically is an institution that's found under the Ministry of Commerce, Trade and Industry. The commission has a two-fold mandate. On one hand, it looks at protecting consumers, and on the other hand, it looks at enhancing competition. So in terms of enhancing competition, there are many ways in which we do this. We look at the regulation of mergers. This is when two companies want to come together into the industry. We have to assess to just see what will happen on the market. And then we also look at the investigation of cartel conduct. This is where two companies or more will come together and agree. And this tends to have an agree on certain way in which they'll conduct business, and this tends to have an effect on the market. Then we also look at aspects to do with abuse of dominance. So we come into this particular topic in the sense that when it comes to major control, you'll find that some of these sectors, or we find some of these green investments will come into the country, and then in order for them to come in, they have to follow through certain procedure with the commission in terms of major regulation. Let me just mention that when it comes to green investments, it would depend on whether that particular enterprise has a turnover or they're already generating a turnover within Zambia. And if they are generating a turnover, then they would have to come to the commission to seek approval, because they need to seek approval because the main thing that we'll be looking for is the prospect of anti-competitive effects that are likely to arise from that particular agreement or green investment that's coming in. Mm-hmm. But in other instances, it depends on the type of transaction. If it's a transaction where the companies have no presence in Zambia, they do not generate any turnover, then the commission would not have to look at that transaction in relation to merger control. But if the commission still can come in, if there are aspects to do with those companies that are bringing in the investments that are likely to abuse certain aspects of the law. For instance, I mentioned aspects to do with abuse of dominance. If they come in and they have a certain presence or market share, mm-hmm. then they are likely to have violated sections. They're likely to violate the certain sections within the law in relation to abuse of dominance, or in relation to any agreements that they may have an effect within the market. So that's how generally we come in as a commission within this topic.
Thanks for that. I mean, for those who are just joining us now, at the far end, Mutumboi has already positioned that Zambia is realigning rules and regulations to become an impact investment hub. Sharon started out by saying that we've got gaps that are there in terms of the framework, the legal framework, the Companies Act, around the role of directors and ESG specifically, because the regulations predate the focus on ESG. We're looking at the CCPC, who have a role in terms of making sure that investments are protected from anti-competitive behavior. Hopefully we can get our investor on the line, because we said we have two regulators, a legal practitioner and the investor on the line. So I'm hoping that Stephen is on the line. We have a link in from Stephen. So let me ask you a question as an actual investor. What type of policy environment do you look for when you assess an attractive environment? And is Zambia one of those? Are we heading in the right direction?
Yes. Yeah. So first of all, thank you for having me on the panel. Yeah. So what kind of environment would we look for? So first of all, I would say both impact investors and commercial investors typically would look for the same components. I think one of the highlights that I wanted to make is from a legal and regulatory environment, what is most important is a predictable environment. And predictability here is it touches on the fact that when you are going in, we have an investment horizon of sometimes, especially as impact investors, it can run anywhere between 5 to 7 years and sometimes even more than that. So during that time, you're battling both macroeconomic challenges. There will be likely political regime changes. There will be likely political regime changes during that time. But if the legal environment is something that is predictable, so it does not change on political whims, or you do not see a history of a sort of flippant behavior from that point of view, then it does foster confidence in the investor. It just means that, yes, I'm coming in, I know that there is competition authority approvals that I need to procure. I probably get a conditional approval. As long as I adhere to my terms, my investment is more or less safe. And when I want to exit, part of what I'm selling to the next investor is this has been the regime. This has been the environmental law regime. This is what we have done to comply with. It's either getting stricter or they are making these improvements, but as long as you do X, Y, Z, then this is the outcome that you will get. So a predictable environment is really important for investors, and that is what we look out for.
No, thank you for that. Let me return to Sharon in particular, who was discussing the point of transformation that's required, evolving regulations rather. So on the one hand, we've got investors who need predictability, and we've got the market that needs an evolution there. Let's talk about incentives, because that's a key point. What incentives are there now for impact investors in Zambia? And if we don't have them, how can we use that to attract more investment?
There are currently no incentives for impact investors, apart from perhaps incentives for public benefit organizations, but those are not really impact investors, strictly so called. Mm-hmm. I have a slightly different view. I think incentives should be provided for our SMEs and our startups through startup legislation that will provide for tax breaks, that will provide a framework for incubation, that will provide for a creation of partnerships. We've seen this play out in other African countries like Tunisia and Senegal. In fact, currently there are about 10 African countries that are putting in place startup legislation. Among those 10 African countries, you have countries like Nigeria, Kenya, and South Africa.
I felt like finishing the list for you.
Which already have vibrant startup hubs, and historically have always enjoyed the lion's share of impact capital. Obviously, there's an argument around size, but I think this just demonstrates the fact that Zambia is in stiff competition to attract impact capital. And because of this, we need to do much more to be able to attract this capital. And we need to position our SMEs as engines for growth by supporting them through this structured framework.
Okay, talking about supporting SMEs, now let's talk about the legal profession. And perhaps billing, a matter people don't like to discuss much. How are we going to have greater access to legal services for SMEs and startups?
I have some radical views. I think these views may attract criticism from some of my professional colleagues. But I think this has to be part of the wider conversation around reform in the legal profession. I think there are several ways in which lawyers and law firms and the profession in general could provide support to SMEs and startups. One way is through pro bono services. If you look at the current pro bono framework, I think largely administered through LAS, the focus is on legal representation through the legal aid board. But I think there's more that non-litigation lawyers could do to support SMEs, to support startups. So I think there's need for a more holistic approach to pro bono services. Another area is shared risk. Currently, lawyers are not allowed to charge contingency fees. So whereas other professions are selling success, lawyers are selling time. And I think there's opportunity for lawyers to share in the risk, the success of a startup. Lawyers could enter into an arrangement with an SME or a startup that provides for payment for legal services that's attached to the attainment or achievement of certain funding goals. That's likely to be a very controversial issue, but I'll leave it at that for now.
Off camera, we discussed something really unusual, and you talked about access for SMEs to the law also extends to the way that the law is written to make it easy to understand so that a startup can pick up the legislation and understand what it means and apply it.
Absolutely. I mean, we live in a digital world, excuse me, we live in a digital world currently. Everyone has access to these statutes. But the question is, how accessible is the content in those statutes? What is the quality of the legislation that we have? And I think it's one of the challenges that was identified in the report that was launched yesterday. If you look at our legislation, there are a lot of gaps. There's a lot of complexity in terms of the drafting language. There's a lot of ambiguities. There's a lot of regulatory overlap. How easy is it for a startup founder or an SME to pick up a piece of legislation and have a first read to understand preliminary processes or registrations without having to engage the services of a lawyer? It's not that easy. I'll give examples. If you look at regulatory overlap, for instance, we have two completely conflicting definitions of a public offer, one in the Companies Act, the other one in the Securities Act. Shouldn't be the case. If you look at our tax laws, they are heavily amended, which demonstrates the lack of consistency in our tax policies. An SME or a startup founder wouldn't be able to determine what their tax obligations are without approaching a lawyer or an accounting firm such as the one that you come from. So I think there's a lot that needs to be done in terms of improving the quality of our legislation, improving the access to the content of our legislation. And this has to be part of the broader conversation around access to justice. But when you look at access to justice in the legal profession, the focus is around access to legal representation, access to the judicial system. There's a need for a broader approach, a more holistic approach.
View. No, thanks for that. I mean, talking around doing it yourself and simplifying access to regulatory services for SMEs. SEC has been innovative here because there's now a regulatory sandbox. Could you tell us about that and what it aims to achieve? Mutumboi.
Okay. Maybe also just before I get into the regulatory sandbox, just to sort of consolidate what other speakers have brought to the table. I mean, our colleague that was joining in virtually raised the issue of predictable environment. I think it's important to state that we're not starting from a basket case situation as a country when it comes to issues to do with impact investment. We do have very good legal frameworks in place. And we also have very good clarity in terms of policy from the new government, and also very good political will. So even as I mentioned that the capital market specifically is going flat out on its 10-year strategy, as captioned in the Capital Markets Master Plan, to position Zambia as a preferred investment hub. We need to be confident as a jurisdiction that we have certain things that are working fine and can literally be extended in terms of even with respect to impact investment. The issue of incentives was also raised earlier. When we discuss incentives, I think we need to look at it broadly. If I'm an investor, to be honest, incentives can be your direct types of incentives and indirect types of incentives. Just having clarity in a legal framework, in having clarity in terms of policies, is an incentive for me as an investor to get into a jurisdiction. And so from where we sit, that is what we are attempting to achieve as a jurisdiction, that there will be that clarity where people know exactly how to access the information that they need to access, and they know exactly what the expectations and what the rules are to participate in the Zambian capital space. Same applies to the SMEs, and maybe now merging it with the issue of technology. It is true that as financial sector regulators, we have recognized the need of embracing technology and ensuring that the public has access to the products that we sit with, they have access to the services that are pertaining, and not just services from intermediaries or the innovators or the licensees that we regulate, but also our own services, as you rightly put, in terms of the laws and the regulations that pertain. So we have put in place as the SEC a regulatory sandbox, although that sandbox is intended to speak more on the product innovation aspect. And what has motivated the creation of the sandbox is we do recognize that currently your capital markets model is one that is enshrined on having a stock exchange. When you examine the stock exchange and the way we established our stock exchange, it was established to be a blue chip platform. So whereby its definition, the regulations that we have in place, it can only be accessed by a certain size of player or issuer, meaning that to put that sort of an infrastructure in a jurisdiction like ours, where you have a lot more people who, a lot more businesses that are small, you have excluded quite a number.
Yes.
So in our thought process, we would like to embrace alternative financing. So the sandbox has been created to allow innovators of alternative platforms, such as crowdfunding, peer-to-peer lending platforms, to come and live test their innovations in a safe environment, just so that we can ensure that products are introduced in the Zambian space in an orderly manner, and that we're managing risk, and the regulator, both the regulator and the innovators, are comfortable with the products that they're introducing. So again, we are opening up the capital space beyond the blue chip stock exchange that has been existing, and which is still a perfect platform for intermediating impact finances. We have a lot of options, and suffice to emphasize that some of the innovations that we have in the sandbox, and I can confirm we have a crowdfunding platform in the sandbox, we have 2 peer-to-peer lending platforms, are very ready for impact financings, impact investors to access those platforms. So if you can chat with me after this conversation, we can discuss how some of those funds that potential impact investors can literally be intermediated through the platforms that we have in the sandbox. And we did go live, by the way, in terms of testing those platforms as at the 19th of November. So we are very ready for impact financing and also for testing some of the things that have been highlighted even in the report. So personally, I do think that when there are challenges, it's important that you leverage the strength and the developments, the good things that are taking place, and address the shortcomings or whatever is not working well. So I hope we can see that happen in terms of what we're testing in the sandbox.
Sure. I mean, when I was listening into the session before, Dr. Mwape was talking about technology really as a game changer.
Yes.
Okay, so that's one example of it. Now, I'll go back to Stephen, who's on the line, because his organization are investing in MFS Africa. Now, a regulator's nightmare is a telco because the rate at which they evolve is incredible. 10, 12 years ago, text messaging was a major source of income, and that's been completely overrun by WhatsApp and other over-the-top services. So they have a product that can transfer money cross borders, cross regulators instantly. So I'd like him to describe that, and we'll talk about the regulatory impact of organizations like those ones. Stephen, are you there?
Yes, I'm there, Mafipe. Yeah, so I mean, if I could briefly touch on that, we did make an investment in MFS Africa. We've actually recently exited as part, basically completing the loop of the full investment cycle. But we did make an investment into MFS Africa, which is a cross-border payments and remittances entity. And the idea in terms of our thesis for that was really to support the development of cross-border transfers of money, not just within the continent, but even from outside. When we think about remittances, we're actually thinking, typically we think from the diaspora back to the continent, but we've never thought about, for those who are doing cross-border trade, how are they impacted by the foreign exchange components, and how are they able to effectively trade between these particular components. So that was our thesis going into MFS Africa. The company has since grown and recently, I think, raised about $100 million for their next phase of development. And as part of that particular round, we were able to exit the transaction because our role is to get in, demonstrate the concept, and eventually, once the concept has diffused, we can be able to recycle our money and go into other particular areas. Just touching on the legal and regulatory aspects for a company like that, it's quite an interesting proposition, especially on the payment space, because whereas we've had a proliferation of regional economic blocks, so SADC, we have the East African Community, you have ECOWAS. One area that has not necessarily grown in tandem with the vision and desires or the visions of the founders of these entities has been the regulatory aspect. So if you think about an entity like MFS Africa, to facilitate a transaction between somebody in South Africa to, let's say, Kenya, two different blocks, you'd have to contend with two different regimes, monetary regimes in terms of foreign exchange regulation. You'd have to factor that in. And right now, I think one problem that actually remittances companies are struggling with is that they have to use a reserve currency as an intermediate between the translation of this currency. So you probably go from the rand to the dollar, and then the dollar to the Kenya shilling. Why does it have to be that? It's probably a function of non-homogenization of our regulatory aspects. So why don't we have a rand to Kenya shilling sort of quotation that can predictably be used by such kind of players without them having to take the FX risk, right? So for us, when looking at an investment like MFS Africa, yes, we look at the potential that they can deliver on the continent. But what we've had to do, and the company has had to do, is contend with regulations on a country-by-country basis. When you think about one of the most important roles, even as the fintech sector develops on the continent and the telco component and the mobile money networks. One of the most important roles that has emerged over the last 10 years has been head of corporate affairs and government relations. Why is that so? Because you have to keep basically moving from country to country, lobbying and trying to find a workaround of basically local regulations. So this goes beyond Zambia. Obviously, it's a call to action to our regional blocks. We now have the AFCTA, which is quite visionary, but already there are payment players who are trying to get into that space and saying, okay, when you look at the potential of the AFCTA, it just means that at its full realization, there will be cross-border payments that will need to happen, and it can't happen with 54 different regimes, local regimes, right? So part of the work that we do elsewhere within FSD Africa is actually to try and engage with the local blocks. If it's the YM region in West Africa, I think there are expectations around East African community and possibly having a single currency regime, just to try and make sure that these rails will be set up in future. Otherwise, if you think about the ambitions of the AFCTA, they will not be attained unless we can surmount some of these challenges that we have. Back to you, Mafipe.
No, thanks for that. I mean, looking at that investment, it's crossing borders, crossing currencies. I can't even imagine how the regulator would be supervising it effectively.
And in which country? Because it covers
multiple countries at once. So if we would rate that almost as a 9 or a 10 in terms of regulatory complexity, what other factors do you look for before you make an investment in terms of the regulations in an environment? Here we're trying to give a heads up to our two regulators who are evolving the environment as we go. Stephen,
yeah, I mean, I would say on the continent, and especially for us as impact investors, regulations have not necessarily proved to be the largest sort of barrier, unless, for example, you are dealing with what we'd call fragile states, where really the rule of law is almost non-existent. And so you almost, maintaining a fiduciary duty, you'd almost not be able to explain why you are going into a particular market. But even in such cases, we do find workarounds and we are able to go into such spaces. I think the way I look at regulations, I find that there are two buckets you can look at regulations. One is that they exist as guardrails for players within a particular segment. So you think about competition authority, you think about environmental laws. They provide guardrails for where all players have to coexist within a particular area. It's trying to protect certain constituencies within the country, which is fair and acceptable. And every country has the sovereign right to actually determine that. The other way I look at it is from an incentive point of view. So where there is a lacuna, what can we do to actually actively pull that capital in? I believe my colleague from the SEC was speaking about the regulatory sandbox, some of the regulations that are actually going into place. And earlier, Naomi was speaking to the issue of sort of green finance and the accompanying law and supporting that. What we have seen is, for example, right now, there is a clamor and a focus on green finance being actively raised and deployed onto the continent. Beyond the buzzword, the question has always been, okay, there are supposed to be incentives that are supposed to accompany a green finance investor. So yes, I'm coming in, the projects have been identified as green projects. Laws can actually provide incentives. So one example is we have engaged with, we did some work with the National Treasury in Kenya in terms of putting together green finance laws that would allow the issuance of green bonds, both by the sovereign and by actual companies. And one of the benefits around that is on tax incentives and actually what actually qualifies as a green project. Now, once that has been defined in law, then both corporates and the sovereign can go to the capital markets and issue green bonds, and they actually have gone and done that. So that's that's already one way of actually getting that impact green kind of capital coming into the local capital markets by just using the function of laws, as Naomi had mentioned.
No, thank you for that. I mean, we're beginning to wind down and get to the point where we'll have questions coming in. But again, I think it's an opportune time to give some thanks to the organizers of the event. The National Advisory Board for Impact Investment have taken a leading role in coordinating key stakeholder groups like these ones that are actually positioning Zambia as an investment hub. Now, behind there's also AGS Zambia, the Ministry of Commerce, the UK Aid, Prospero, and Zanaco, who've all come in to give support. So we'd just like to take a moment to acknowledge those. Join the conversation. The event is live on Facebook. You can get involved on NAB_Zambia on Twitter. And we'll return to the questions now. One point I've been going on about has been the cost of doing business in Zambia. I already had the back and forth with Sharon about legal fees and how they can be moderated to accommodate the role of startups. Mutumboi was very clever on the far end when she said that the platform was built for corporates and now it's already under reform. But let's look at CCPC for just a moment. Again, complying with a lot of the requirements of CCPC cost money. How are you moderating that or revising the cost so that SMEs can also afford them?
Okay, thank you for that. So one way in which we're looking at this is when it comes to major regulation, the Commission has come up with guidelines, and these guidelines have, the major guidelines have stated a minimum amount of where companies can come in to pay a fee. So we've put in thresholds within the law and they're stipulated within the guidelines. So these thresholds, when it comes to major regulation, when two companies want to come together, or when there's a green investment that wants to come in, or a brownfield investment, whichever, there are thresholds which have to be complied with. So when it comes to thresholds, we have set a minimum. So if you have 15 million kwacha and below, it could be turnover in terms of turnover or assets. If you have that, then there is no need for you to come through to the Commission to notify with the Commission the transaction that you're getting into. But if you hit the mark, the 15 million mark, then you would have to come to the Commission to notify your transaction for us to be able to assess. I must also add that the reason why we have to look at this transaction is the prospects of the anti-competitive effects that are likely to arise when two companies merge, because you're probably ending with having two companies on the market with one you're going to end up with one company. So there's a likelihood that competition will be reduced, and then we would have to look at the trickle-down effects that are going to happen. But I must also mention that the Commission is in the process of amending the law. We do realize that, and we've heard from a number of stakeholders that the threshold that has been put in place in terms of major regulation, the 15 million, which I mentioned, which is turnover or assets, whichever will be higher, is too low. So we are in the process of revising our law. And once the law is revised, we will also revise the threshold at which merging companies can come through the Commission to seek approval.
In fact, returning to the wider ESG discussion, we need to have something to attract impact investors. And one area where we can make an improvement is better disclosures around ESG in general. So over to Sharon, what's the current state of our regulatory requirements for reporting ESG performance?
So currently, the only framework that exists is under the Corporate Governance Code of the LUCE listing rules. The Corporate Governance Code contains a section on sustainability, which is applicable to public companies listed on the LUCE. So these companies are required to report in their annual reports on their compliance levels in relation to the requirements as they relate to sustainability in the code. But when you look at those requirements, they are really very high level, and they're more of CSR requirements. So I think there's really need for a more robust framework for disclosure, that is for listed companies. As Mutumboi mentioned, the stock exchange and the rules there apply to the blue chip companies. But what about the SMEs? There is currently no framework for disclosure, and I think there's need to develop some form of framework so that we can have a standardized level of disclosure. And I think one way would be to undertake this reform in relation to fiduciary duties. Compliance would obviously be a challenge, but I think we've got to start somewhere, and we could have different standards applicable to different companies based on their size or based on their sector. But I think we have to start somewhere.
One of the criticisms of the current regulatory environment is that it's too expensive to comply. You've now downscaled quite a few of the investment products and brought in the sandbox to drive peer-to-peer lending and also green investment directly in that form. Are there discussions around reduced costs for compliance in that new framework so that more SMEs can get involved?
Yeah, but maybe I can also pick up on a statement made by Stephen. And I think what he said was, in their experience, regulation hasn't really been an issue or you know, a major challenge. So the cost of regulation for the sandbox, yes, has been compliance, has been substantively reduced. Starting with just even how you participate in the sandbox. So for you to get a license, you need to pay quite, you know, considerable fees. We have zeroed the fees for the first cohort, and the intention is to just have a small fee of, I think, 2,000 kwacha going forward with the subsequent cohorts. But then the bigger issue of reducing cost is more on the transactions, in my view. And some of the innovations that we have in the sandbox, yes, they are outrightly intended to achieve reduced costs, not only to the innovators themselves in terms of compliance, but also to the end users. And what we are seeing now in the sandbox is we're trying to innovate around how do I reduce the intermediaries' cost, and using technology as a means of reducing that cost. Similarly, in terms of our own reporting requirements, would like to reduce the cost by making using supervisory technology, regulatory technology, and there are projects, as I speak, in the sandbox that are developing tools also for the regulator that are aimed to reduce compliance costs. Kenya specifically has a product that we are eyeing all the way in Zambia in their regulatory sandbox of how we can reduce compliance costs. So the opportunities are there, Mafipa, and we really just have to be come to the party and to leverage these initiatives that have been put in place.
I like the direction you've taken of saying we've really got to position ourselves now as that hub for impact investment. That opportunity is there. Looking around the room, it's an opportunity for questions. Also online, if there are any questions that are coming through, you have access to 3 fantastic panelists here and an investor, an actual green investor who's online. I can see a question over there. If somebody could take the mic over.
Bruno Mwemba is my name, from the Biodiversity Finance Initiative, BioFin. We are supporting providing actual technical assistance to the Green Finance Mainstreaming Working Group that Mutumboi did talk about. But one thing that I must actually hasten to say, sometimes we do focus on negatives, but I must actually indicate that from the time we started actually, engaging with the regulators of the financial sector, that's Bank of Zambia, SEC, and PIA, we've actually seen quite some very huge, what I call regulatory will. I know we always talk about political will, but I think there's huge regulatory, will on the part of the financial sector regulators, and I think that's quite commendable. The only issue that I must actually hasten to indicate is that we need to avoid what I would call regulatory fatigue, I think on the part of the regulators. And sometimes this comes with what I would call, narrow focus initiatives. Everyone is trying to push some very narrow, aspect towards the regulators to reform. And I think one of the areas that we have sometimes is the misconceptions or not understanding, perhaps especially the issue of green finance, where we equate green finance to climate finance alone. Yet there are other aspects like biodiversity conservation, land degradation, and things like that. So we need this holistic understanding of the space that we are in, so that we avoid these narrow, initiatives being pushed towards the regulators. Otherwise, each one will go with the narrow, push. So I think that there's need for collaborations across different, players. Even those, I think, in the impact investment space, we can bring in the other, social aspects which are critical for impact investment, blending with the environmental, matrices, and we avoid, being a repository of different documents. Already we have a tag at Zambia that we're very good at churning out beautiful documents, plenty of them, but then little action. So let's push for collaborations, towards, regulatory reforms, and then we see a lot more, I think, traction on the ground. Thank you.
No, thank you for that contribution. Are there any others around the room? While we look for that, let me turn back to a colleague from CCPC, Nami. Although much of the focus has been on creating new regulations and enforcing them, CCPC also actively provides protection for customers and clients in the market. Could you speak about that role as well? Because many SMEs are not aware that they don't necessarily need legal representation to raise a complaint about anti-competitive practices.
Yes, so as I mentioned earlier, the mandate of the Commission is twofold. And so far I've talked about the aspect to do with enhancing of competition, but we also look at the protection of consumers. So we have a number of provisions within the law, the Competition and Consumer Protection Act, that looks at protecting consumers. It must be mentioned that consumers are a weaker party to any transaction. So the Commission has a number of provisions in order to look into the welfare of consumers. With these provisions, it must be said that, because sometimes we get that, no, the Commission is so concentrated on the consumer. But whenever we get any of these complaints, we weigh. We look at the consumer has come in, has brought in this complaint, and we also look at the aspect that we need to hear from the other party, the person who's being complained against. So we give an opportunity in a number of ways for the person who's complained against, this can be a shop or whatever institution it is, for you to be able to give back your feedback in relation to the complaint that has come through. So yes, the Commission has a number of provisions that look at the protection of consumers, and it's not necessarily that when you come in you have to have legal representation. You can come in and we will look at the matter even without legal representation.
Thank you very much. I'm looking for any final questions as we close out.
Thank you so much. My name is Philip Ngongo. I'm from Global Commodities Advisory, an investment company. So my question goes to Securities and Exchange Commission. The cost of issuing securities, it's very high, and I do understand that the role which SEC has in the market is not just to promote, protect investors, but you have the mandate to develop the market as well. I've been in instances where we were trying to issue a commercial paper, and when you look at the cost, it's as high as 30,000 kwacha, and SEC is getting a sort of percentage from the maximum transaction value that you have under that security. So I feel it's going to be a bit difficult for us to develop the market if SEC is position itself as, like, for me, I see it as if you're trying to make money and not to develop the market, which seems to be sad. Yeah, I don't know if there's anything that you guys are doing to lower the cost of, issuing securities in Zambia and developing the market.
I think we'll start with Stephen on the line. Thank you very much for joining us all the way in from Nairobi. If you give any closing remarks, Stephen, and advice to our regulators and green entities looking for investment.
Thank you, Mafipe. Yeah, so I'd say we remain a confident investor. We already have investments in Zambia. We are an investor in Zambia home loans. I think as an example of the great collaboration that we have had is during the onset of COVID-19, we had a facility extended to the company from the Central Bank of Zambia, and we were able to take that up just to show how agile the regulators are in that particular market. I'd say from what I've heard and even from our offline conversations, there's a lot of momentum happening. I understand, especially from the fintech and the technology side, there's a lot of caucusing that's happening on how best to improve the regulations and allow for Zambia even eventually to be like a Delaware of on the African continent. And I think those are great steps that are happening. The entrepreneurial class is already a quality class. We've not lacked for entrepreneurs in Zambia. I think the regulations will eventually catch up and continue to be facilitative. So thank you for having me on the panel, and look forward to engaging with any of the participants in the forum on how FSD Africa can support initiatives as you go on this journey.
Thank you so much. Thank you for your contribution. Over to you, Sharon. Closing remarks.
Thanks, Mafipe. I think it's important to recognize that we are in competition with other African countries to attract impact capital. Yes, the intent has been set to develop a green economy and to position SMEs as a growth engine for economic development. There's need for regulation to evolve to facilitate the actualization of these objectives. I would like to point back to one of the issues that was raised on the pensions panel yesterday. This is in relation to the fund formation structures that are currently available, which at the moment do not allow local funds to attract capital from foreign investors. This is because the formation structures that we have are not widely recognized. The structure available is the collective investment scheme. And I think we heard from Basil Nundo, I don't know whether he's in the room, about how it's just not working. NAPSA also mentioned that they are uncomfortable with that sort of structure. In fact, NAPSA mentioned that they're sitting on up to $300 million that could be available for private equity transactions, impact investing. But the key issue they face is risk. And one of the solutions put forward was the need for local pension funds such as NAPSA to invest through funds alongside DFIs and other investors as a way of sharing the risk. So I think for me, we need to emphasize the point of providing structures that are widely recognized. The typical LPGP structure is not recognized, is not tenable in Zambia because the concept of a limited liability partnership doesn't exist. We're still relying on an 1890 UK Partnership Act. I think that issue alone could help us attract significant amounts of capital if it was addressed.
Food for thought, particularly for the regulators and the framers of our laws. Over to you, Naomi, closing remarks.
Just to say that there was mention of a predictable environment. I think just to say that with the Commission, we have a lot of processes which are clearly stated. And I think our law is pretty predictable when it comes to approvals that have to be taken, or if you make an application to the Commission in terms of measures or whatever form of approval you are seeking from the Commission. So maybe just to say that our approvals, our processes rather are predictable and they're clearly laid out within our various guidelines. So it's easy for people to know at which stage or what exactly is required, timelines and everything are clearly stated within our documents. And also just to mention that with the Commission, we're not here to frustrate business. I know sometimes it might be said that our approval processes take long. For example, major approvals take 90 days, but that's a requirement for us to be able to do an exhaustive assessment for you to be able to get that approval. And as I mentioned as well, we are in the process of amending our act. So it's just to urge all the business community and just the SMEs in particular that if there are any issues that you have noted within the law that you feel could be improved upon, there's still time right now to come through to the Commission and make those suggestions before all the approvals for the amendments are done. Thank you.
Thank you. So as we're closing, please go ahead.
Okay, now in my closing remarks, I really want to reiterate my thanks to the National Advisory Board and their partners in facilitating this important platform. And really a key takeaway, I think, that I would love you to go with from here is an acceptance that we are in competition for sure for capital. And the owners of capital indeed do expect certain things to be right in a jurisdiction. Zambia has recognized that capital is not a respecter of national level challenges. Basically, an investor out there, an investor in here, the reasoning is the same, and you're looking for certain things to be right in an investing environment. And as the regulator for the capital markets, we are cognizant of the need to continuously improve the regulatory framework and to ensure that we're enabling. The vision as contained in the Capital Markets Master Plan, where we seek to position Zambia as a preferred destination for investment, and I say it again, be it brown funds, green funds, or indeed impact capital, requires that we do a lot of housekeeping, which includes the issue to do with fees. Fees have been captured as one of the issues that will be tackled in the implementation of the master plan. And just suffices to mention that regulation comes at a cost. And the regulatory environment is overseen somehow internationally. So if you are competing with other jurisdictions in the international capital space, you need to step up to those international standards. So whether we like it or not, there is the need to be seen to have the right frameworks in place, and that costs money. What we probably ought to be discussing is, do we have the right funding model for the Securities and Exchange Commission? And if it's not the right funding model in the sense that it's imputing too much cost, it's very simple. The funding model should be addressed as part of how we implement the Capital Markets Master Plan. I really want to emphasize that we have to be very intentional on how we leverage the new wave that we're in. We have seen already from our sector the positive sentiments and how that has impacted positively. Mm-hmm. The LUCE index is high up there. We've seen a lot of counters, prices increase. The positive sentiment is unmistakable, but what matters is how we nurture that to achieving the things that we want to see, which includes sustainable development. On our part as a SEC, we're extremely committed to the agenda of positioning ourselves as the preferred destination. It's not going to be easy. It will need a lot of work, a lot of discourse, discussions, collaborations, and this forum is one to thank because it has kicked us in terms of the things that we want to be discussing and to see in the near future. Thank you.
Thank you very much. My name is Mafipa M. Chunga from KPMG. This has been a presentation on reshaping financial markets, looking at how regulations can promote impact investment. National Advisory Board for Impact Investment, thank you very much. Board sponsors, thank you very much. People on the panel, thank you very much. Round of applause as we close.